This fund manager is holding 60% cash and expecting a stock market crash. There's bearish, there's really bearish, and then there's Ruffer and Company. I don't want to spook everyone managing their own retirement portfolio. But the London-based money managers, who successfully anticipated the dot-com collapse and the global financial crisis, are expecting an almighty stock market crash, are now holding nearly 60% of their flagship total return fund in cash and short-term bonds. The fund is now hiding even deeper in its bunker than it was in 2007, before the global financial crisis, co-manager Steve Russell says. Its exposure in 2007 was similar in terms of low equity exposure, he tells me. Central banks could soon find themselves in a much trickier situation as inflation, base effects, and, now rising, energy prices switch from being disinflationary tailwinds to inflationary ones, he and his co-managers wrote. But if economies reaccelerate, especially in the US, it raises the specter of a second inflationary wave, with further rate hikes. Certainly, the dramatic surge in Treasury yields in recent weeks would suggest the markets are now starting to expect not just higher for longer, but much higher for much longer. Since the start of August, the yield on the benchmark 10-year Treasury note has risen by a fifth, from 3.96% to 4.74%. Our settled aspiration is avoiding the market crevasses, and in this we have been successful in every case going back to 1987, he wrote in July. It's been similar this time around. The Japanese yen, typically a safe haven currency, has been plunging all year, as hedge funds and others borrow at low interest rates in yen and lend at higher interest rates in dollars and other currencies. That currency mismatch is making money for them. In addition to the small interest charge they pay, their contentment has turned to happiness, Ruffer wrote. He concluded that a long-term investor should never be less than 60% invested in stocks. This time around, the turmoil in bonds and stocks is spooking many ordinary investors. They don't need to liquidate their portfolio, but they should make sure they can handle more volatility ahead. This isn't a case for being 60% in cash, but it is a case for not being 100% in stocks. If the stock market suddenly hits an air pocket, especially a deep one, it's good to be able to buy more stocks. Thank you for watching and happy investing.